And let me share my screen. Okay, so let's start with the specialized returns. One of them is a gift tax. Then we have is estate. Then we have is a final return and foreign taxpayers account. Okay, F bar and those things. So in case of a gift tax and estate tax, what we have done when a person dies, I hope you remember the whole sequence. When a person dies, they have to file a 1040 final return in the year of death. Okay, just a minute, guys. Okay. So when you're going to file a final return, like when a person dies, you have to file a 1040 final return. At that time, you need to check whether that person was married or not. If a person is married, they have to file a MFJ return. Okay, the taxpayer plus spouse will file a MFJ return in the year of death. Okay, I hope you guys remember this thing. And after this, within next 9 months, they have to file a estate tax return. Estate tax return from the date of death. Let's say a person died in the month of November. So from that, calculate 9 months. Within that, you have to file the estate tax return. So, in our estate tax topic, what we have done, what all things will be considered in the income, what all things will be allowed as a deduction, what is the net income which will be reported on your estate tax return. Okay, so for estate tax return, you are going to file a form 706. On that, you need to pay the beneficiary are going to pay the estate tax. Okay, now after that, if they are having the person who died is still having some asset, still generating some income, so for them they have to continuously file a trust tax return. Okay, when the person is still having some incomes 1041. Okay, clear, guys? Over here, you are again going to report all your income deductions uh, on your trust return, and this will get transferred to the beneficiaries in the form of K1s. Okay, so this is a whole process. I hope you guys remember that, right? Final return, then within 9 month estate, and then trust. Now, what is a gift tax return? Just like a normal gift, if you're giving it to anyone, it can be your family member, it can be anyone other than family member. So for them there is an exception that up to that much amount you can give them as a gift, right? But over and above that, if you're giving them as a gift, you have to pay the gift tax. Who pays the gift tax, guys? Who is giving the gift? The giver, the donor is going to pay the gift tax. The receiver doesn't have to include it anywhere in the tax return. Okay, none of the amount is considered as a taxable. Okay, so just give me a minute, guys, else there will be a confusion. Okay, so let's start first with the gift tax topic. Anyone who has already done this topic and having any questions, start typing it on the chat box quickly. So till the time we complete the topic, your queries will also be resolved. In case of gift tax, when there is a transfer of a property, okay, or if you are giving some cash, or you're transferring the income in the name of your friend or family, anyone, or tangible property, that is movable property, if you're giving it to someone, then if it is sold at less than the FMV, it can happen that you are selling it to your family member at a lower price. Let's say your fair market value of your own house is 500,000, but you are selling it to your sister for just 200,000. So you are selling her for less than FMV. Whatever is the difference between your FMV and your sales price, that is 300,000, will be considered as a gift. Okay. So understand this thing. Your gift can be of three categories. One will be your cash or property or like tangible thing you're giving. Second category, you can give them the interest. Interest means like if you're giving them a loan, okay, you're not exactly gifting them the money, but you are giving them the loan but at a reduced rate of interest, right? So they have the benefit of paying less. And third one is a future interest. So I think someone asked me previously in the class, what is the future interest? So I am donating a fixed deposit, okay, fixed deposit, which is going to be matured after 2 years. So the person who is going to receive the benefit is after 2 years. This is a gift of future interest. This is also called as a gift. Or let's say I am giving some shares and securities on which the benefit is going to be accrued after a certain age, right? Any person being a minor, if he receives a gift but there is some restrictions, let's say he can only use it after the age of 18 years, or those age limits are the restrictions. So this is a gift of future interest. Right now you're not going to receive any benefit, but in future you're going to receive it, a benefit. So that is also a gift. So gift can be of three categories, right? This three will be considered under your gift tax topic. What are the non-taxable? This is the most important. Okay, so please mark it as a most important. Your exam questions will be based on this. Okay. Um, okay. There is one question in regular book. Complete gift. There is an example. If in future donor revert the gift back, so it will be called as a complete gift. Okay. Yeah, I'll tell you, Krishna, let me come to the point. So I'll tell you that query, I'll resolve that. And Chawla, you have just mentioned question 28. Just send me a photo. If you have already sent me on WhatsApp, just reply me. I'll take that from the WhatsApp. Make sure when you guys tell me that question number 20, 21. I don't know the sequence. I'm not going to go and check each and every MCQs. Just try to send a photo. I think Marilyn used to send me photos. Few people send me the photos of MCQs. So do that thing, okay? It will be easy for me also to revert it. Okay. Yeah, so you have sent me a photo. Okay, I'll take this MCQ. This is a good one. I'll take this MCQ after I explain this exceptions. Okay. Now see what happens. What are the non-taxable gifts? This is most important. They'll give you a list of items which you have donated, right? And then you have to figure out what is your considered in your gift or not. Because up to certain limit, what's the limit, guys? Up to 17,000 you are not going to consider under gift tax filing. Okay, you don't have to pay any gift tax up to 17,000. Means two things you have to check. First, you need to check how much are your total gift. Is it less than 17? No need to consider under the gift tax filing. Okay, we'll take one example. Chawla, your example only I'll take, the MCQ which you sent. Okay, so now what are not included in that calculation? Gift of future interest. So this is a gift, this is considered as a gift, but right now you are not going to consider for this 17,000 limit calculation. Okay, any amount which is up to 17,000 per year per taxpayer. So per person, this 17,000 limit is for per person. Let's say I gifted Binit a cash of 10,000, so it is within 17,000. I gifted Chawla a cash of 12,000, again it is within 17,000. So this 10,000, 12,000, I'll not take into consideration for gift tax filing. Okay, same way I gifted to Krishna $20,000, so it is going above 17,000. That amount I need to report on my gift tax return. Okay, I have to pay the gift tax, I have to file the gift tax. But there is one more exception. take a total amount of whatever taxable gifts are there. When I say taxable gift means when it is going above 17,000, and then check the tax liability on this. If your tax liability is within 511 3800, this amount, then no need to pay any tax. Okay, so ultimately this is a lifetime exclusion, huh, guys. Please remember, for gift tax, this is a lifetime exclusion. And from the amount of gift, again, there is a lifetime exclusion of 12,920. I'll tell you how to calculate it. And in exam, they are going to merge your gift and estate thing, because for both gift and estate, these two are the exact limits which will apply. Okay, so let's first complete the non-taxable portion. 17,000 is per person per taxpayer. You are not going to consider as a taxable. If you are incurring some medical expense, or if you're paying the tuition fees directly to the medical or education institution, then there is no limit. Now they will confuse you that you are paying medical expense, you're reimbursing. Reimbursing is not allowed. Okay, just a minute. Can you explain first point of taxable gift? Rishabh, see, if in regular class this topic is not done, then wait for it. This is just a summary lecture. This is not a regular lecture. Okay, so I am trying to complete it. It's whole 8-hour session which I have to complete it within 2 days. So I'm not going to take it in very much detail. I'm going to just explain it in a summarized format. Plus, if people are having the doubts on the spot, I'll clear the doubts on that topic. Okay. So I know in your batch the topic is pending. So wait for the regular class to complete it. This is just for those who are having the exams in December. Okay. So if you're gifting to someone in the form of medical expense, gifting means you are just paying their medical expense, paying their tuition fees, but it has to be directly paid to the institution, to the hospital, to the education institution. This can be for anyone. See, gift can be for friends, family. There is no relationship test over here. Third, next one is gift in case of a marriage. So if you're gifting to your spouse, there is no limit in that. You can gift cash, property, jewelry, anything, but there is no limit in that case, and this will not be considered under the gift tax topic. So this also will not be considered. Gift to a political organization for its use, this is not a gift. Okay, if you're donating something to a political organization, that will not be considered as a gift, and it will not even considered as a charitable contribution. You will not get any deduction for that. Okay, last is gift to charities. It's not your gift because it is considered on your schedule A as a deduction, so it will not fall under gift calculation. Okay, sorry guys. So let me take that example, just one numerical example how to calculate the this gift amount. So let's say a person who is not married has made few transfers during the year. He made a transfer of 10,000 to his son. He made transfer of 18,000 to his daughter. Okay, first of all, you guys will tell me the answer, then I'll explain you. 7,000 in the form of political contributions, 5,000 in the form of charitable contribution. Okay, car, he gifted a car to his son. 24,000 was the basis, but the FMV was 18,000. Okay, gift of car to his son. Okay, then one more is baseball, autograph of a baseball player to the grandson, which was having a basis of 75, right? And FMV is 500. So this is a gift of autograph, I can say. Okay. Then what is the gross amount of gift that John, okay, so the person who is gifting is John, will report on their 2023 return. So please remember, these exceptions you have to keep in mind while calculating your total amount of gift. 17,000 is a per person thing. Okay. per person. So just reporting how much you are going to report on your 2023 gift tax return. So guys, calculate it and let me know what's the answer. Till then, I'll also calculate and let you know the explanation. Everyone, please. What they are asking is, wait, I'll tell you what they are asking is, what is the gross amount of gift that will be reported on 2023? See, understand this thing. There is a one thing which is gross amount. From that, you will exclude the exclusions. Okay. In exclusions, you have three things. Okay. What are the exclusions? What are this? Okay, up to 17,000 per person. 17,000 per person. Then you will reduce the medical related expenses, then you will reduce education expenses, then political contributions, then charity. This all will be reduced from this, and this is your net amount which you need to report on your 706. So what they are asking, what is the gross amount? This is a trick which they will also use in exam, that people will start calculating, excluding, and then they'll straight away report this. Your answer should be how much is the gross amount which you need to report. So everything you have to consider first of all in your gross calculation. Got it, Chawla? Everything has to be considered on your gross amount of your calculation. So let me calculate it quickly. It will be 10,000 plus 18 7 5. While gifting, take FMV plus 18 plus 500. So your answer should be 58,500. Just a minute. Minus 18 minus 500 plus 24 plus 75. Okay. So your total should be 10 plus 18 plus 7 plus 5 plus take FMB always. So Chawla, your answer 58,500 is correct one. 18 plus 500. And they are asking about gross amount. Okay. So do not exclude anything if they ask gross amount. So read the question carefully in exam. It should be either they are asking gross amount or they are asking the taxable. See, if they use the word not taxable gift, then you have to see this will not come. This will come because it is going above than 17,000. This will not come. This will not come. And over here, this FMV is going above your 17,000, so you have to consider this. Here it is not going above 17,000, so only this two will be considered as your taxable portion. But this is the calculation, you have to follow it. Okay. Did we donate used to donate to political party in gross amount? This 7,000 will be it will be added in your, it will be added. See, everything which you are gifting will be first added, and then what are your exclusions, the points which we saw right now, this will be excluded on the second step. And third one is your net amount, that is your taxable portion. Okay. All right, so now next one is this exclusions. You have to remember each and every point. They are going to ask very simple question which will have a straightforward answer, but you need to remember the limit also, 17,000 per person. Just for calculation of the gross amount, you have to check whether it is considered in the taxable portion or not. Okay. Now next is a lifetime exclusion. So even if you reach to a conclusion, let's say this 18 plus 18, 36,000 is your taxable portion, you have a balance. It's a kind of a balance for you. It's a lifetime exclusion balance. Okay. So lifetime exclusion balance means whatever you are gifting during your life, even when you are transferring everything in your estate. So at the first in the first session only, like right now only I've explained that when a person dies, his all asset will be reported under estate tax return. So when you're going to report in the estate tax return, you have to pay a one time tax, the difference between FMV and the adjusted basis of the property, right? That is your estate tax you're going to pay. But here also, if you still have a balance in your lifetime limit, okay, what's the lifetime limit over here? During your whole life, you can gift up to 12.92 of your either it can be cash, either it can be property, in any format you can gift, but up to this much amount, 1.29 million will be considered as an exclusion, right? So first exclusion you get is 17,000 will be excluded. Okay, over and above that, like if your amount is going over and above that, the whole amount will be added in the gross taxable portion. And that taxable portion, if it falls below this, then you just have to reduce your balance. Just think like this is your lifetime balance, 12,920. Okay, this is your, just a minute, yeah, this is your balance. Okay, as and when you are not going to pay the tax, let's say this 36,000 right now is excluded, so your balance will get reduced. Clear, guys? So there will be a question where they will ask you to calculate how much lifetime balance still is there in this particular person's exclusion limit, and this limit every year gets revised. Okay, so please remember this limit, and there will be simple one line question. I don't know in part 1 or part 2, there is a simple one line question. Okay, there is something in the chat box. Tom gave vase worth 40,000 to his sister. Base in the vase is 10,000. What amount Tom report as a value of the gift? See here, do you guys remember the gift topic which we did? Anything which is having the FMV. See here in your example, Krishna, the FMV of the vase is what? 40,000. But the basis is less. Do you remember that example? If the FMV is more than the basis or FMV is less than the basis. If it is more than the basis, then your adjusted basis will be considered as a basis for the person who is receiving it, right? But the person who is gifting, they have to report FMV only every time. Remember, here also I took the FMV. Do you remember this? Every time your FMV should be your value of the gift. Okay, Krishna? Could we use same example for taxable amount of gift? Yes. Okay, let's use the same example. Here the taxable amount is 18 plus 18, 36. Okay, now your lifetime limit is 1920. Out of, since this 36,000 is within the limit of 1920, so your balance will be reduced, and the remaining amount will be carried forward in the next year. Let's say again you gifted something which is around 50,000, so you don't have to pay any tax. It will just reduce your lifetime balance. You get 3 time exclusion when it comes to gift tax. 90% of the US citizens don't pay gift tax because of this huge limits. Okay, and it is going to change in the next year. Maybe they are going to remove something from this. Okay, same way for the estate. When a person dies, we'll see that in the estate topic. Okay, till now it's clear, guys. Just remember the sequence. First 17,000, then whatever is pending, again you get an exclusion of 12,920, and there will be straight one line question. What is the lifetime exclusion limit? Straight one simple question will be there. You have to remember this limit. Okay, now what happens? Let's say if you are gifting something and you don't have any lifetime exclusion balance, so you have to pay the gift tax. Okay, so whatever is your gift tax liability, okay, tax liability, on that you get a credit. Means you don't have to pay the tax liability up to 5,113,800, and this is also a lifetime exclusion. So this is a kind of a balance of your credit, and this is a balance of your exclusion. Are you clear with this, guys? Any question on this? Just put it on the chat box quickly, so you don't get any confusion or anything. Next is annual exclusion is 17, but if a person is married, they can go for a 34,000 as a exclusion. But yes, both husband and wife both should mutually agree for this. And there was one MCQ that if even they are going for 34,000 as an exclusion, both will have to file a separate gift tax return. Gift tax return is never filed as a married filing jointly. Both will have to individually file a separate gift tax return. Okay, so separate return will be filed. Clear, guys? So lifetime exclusion limit you have to remember. Non-taxable gifts is clear. What are the exclusions? You have to remember this 4 5 items. Make sure to understand the difference between the gross amount of gift and the net amount of gift. Now, in case of exemptions and deductions, understand this thing. What are the exemptions and what are the allowed deductions? Okay, yeah, just a minute. Then we have a generation skipping tax as well. Okay, see, what are the exceptions? We have medical, education, and political. These are exemptions. No need to file 706 if you are just donating this three items. You're just gifting this three items. But in case of marital deduction, if you are transferring something to your spouse and the spouse is a non-US citizen, any gift over and above 175 will be taxable. So please remember this thing. They might not ask directly, but indirectly it will be there somewhere in the question. They'll give you a line items in which the gift to a spouse is, let's say, 180,000. So it is taxable if it is more than 175. Okay, then we have a charitable contribution. No need to report if there is no other reportable gifts, but if there are, then you have to report other gifts plus charitable gifts both, and take the deductions on 1040 as a charitable contribution. Are you clear with this? See, it's very simple. Let's say you have, in our previous example, we had political contribution, we have charitable contribution, we had given a gift of cash, we have given a property, okay, whose basis and fair market value was given. So take a total of all, it should be reported on your 706. Just charitable contribution, if you're giving, do not file separately 706. Okay, if charitable contribution is there along with other, then you have to report it as a gross amount and then take an exclusion because it will be reported under schedule A. Okay, I hope everyone remember the charitable donation thing. It goes on the schedule A, 60%, 30%, right? That also we are going to revise on schedule A topic. Any question on this? Just exemption is thing is given, which we have already done, and marital deduction is limited to 175. When I talk about charitable contribution, only charitable, you don't have to report on your gift tax return. But along with charity, if you have given some other gifts, cash, or you have paid some bills of medical or education, these exceptions are also there. You have to report it in the gross amount first. Okay, now, deductible gifts made to a charity will include taxpayer entire interest in the property or qualified conservation contribution. That is what you are just donating. You're not donating the whole property, but you are giving them the usage of property. Okay, the charitable organization cannot sell it, but they are going to use it property for few years. Let's say I donated property usage for 5 years, so next 5 years after that, the whole property will again be transferred back to me. So I think, Krishna, what was your question? Completed gift thing was there. uh, can you explain first? No, complete gift example, if in future donor reverts the gift back, so it will be called as a completed gift. Yeah, so what is completed gift? Let's say, Krishna, I donated you some property with some restrictions, right? Let's say, I donated you a property and said that you can start use after 1 year. Okay, so right now it is a future interest gift, it is not a completed gift. But as soon as the 1 year is completed, in next year I will consider it as a for the gift tax purpose. So at that time it will be considered as a completed gift. Okay, that will be the scenario. Right now it is incomplete gift, I have not given you the rights to use the property, but after 1 year you are going to receive it, so it's a future interest gift. So as soon as your future restrictions are lifted off, you can use it, so it's a completed gift. Okay, so here it is, see, gift of future interest, it cannot be excluded under annual exclusion, means on this 17,000 limit is not applicable. Any gift which you are giving for the future interest, you have to report it on your form 706, right? 79, just a minute, huh? Sorry, 709, yes. So you have to report it on your form 709 for any future interest, whether it's just a $1, $2, then also you have to report it right now, because then only I'll able to see. You have to just report it, do not pay any gift tax, because then only the IRS will come to know, yes, after 1 year you have to make it a as a taxable portion, right? So you have to report it. There's no exclusion of 17,000 applicable on this, because we have seen the calculation while calculating this, calculating the total reportable gift, we check 17,000 limit. But if it's a future interest, no need to check the limit, straight away you have to report it. One example is contribution to qualified tuition program. Do you remember this qualified tuition program 529 plan? When the parents are going to invest for their child, right? It's a qualified tuition program, and they are just putting the money in this program. Let's say 50,000 they have added over there. After 5 years or after 4 years, they are going to receive the benefits. The minor child, when becomes major, they will start receiving the benefits from that. Okay, so can I say this is a gift of future interest? So this will be considered as a complete gift of present interest. This is an exception, I can say, that even if they are contributing right now, the benefits are going to be received in future. It will look like it's a gift of future interest, right? But just for this particular topic, it will be considered as a completed gift of present interest. But if I say, instead of taking this example, if I say that I have deposited a money in a bank account, and I have put a restriction that a person, if achieves certain things, then only it will get transferred to that person. So the situation is uncertain. Once the restrictions are lifted, at that time it will be considered as a complete gift. Here, in case of a qualified tuition program, there is no other way the person is going to misutilize. If they are misutilizing it, that's a different thing. But in qualified tuition program, it is being deposited with a purpose for education thing. Okay, are you guys clear with this completed gift, incompleted gift? So donor can front load the what's the criteria of this particular program? They can front load the whole amount for next 5 years, right? So how much they can front load without considering it is a taxable gift? 17,000 into 5. Now this amount will get revised every year. Last year it was 16, 15. This year it's 17. Next year it will again change to 18 or 20 maybe, right? So this amount into 5, if this 85,000 you are front loading, means you are depositing right now, so it will be divided in next 5 years. So per year the limit comes as 17,000. Whatever amount you are doing right now, whatever contribution you're contributing right now, will be excluded in each of the 5 year beginning from the year of contribution. So every year you have to take a 17, 17, 17 as a gift exclusion. Okay, right now you are going to take 85,000 as a report, 85,000 as a gift given to the son, because It's a qualified tuition program and it will be considered as a completed gift of present interest. Okay. And then every year you can take an extra exclusion of 17, 17, 17 for the next 5 years. Are you guys clear with this? Any question? Any question, guys? Okay. If you have any MCQ or anything which is, relevant to this, or if you find it difficult, just let me know. Okay. Next is generation skipping tax. This is being reported as a gift tax when a donor is going to donate something to a generation who is, like, after skipping the two generation, let's say your grandfather is donating something to father, that's fine, gifting something to father, grandson, and his son. So if you're skipping two generations, then you will have to pay a generation skipping tax. Okay. And make sure the difference between the donor and the receiver should be 37.5 years. Then only this rule is applicable, and you can easily take a lifetime exclusion of 12.92 million, which we saw earlier. Okay, that much amount will be non taxable. Else, you have to, the grandfather who is going to give the gift, they will have to pay the generation skipping tax. Okay. Clear, guys? Generation skipping tax is clear. Gift of future interest is clear. Krishna, is it clear? Gift of future interest, completed interest, present interest, right? When the restrictions are lifted, then only it will be considered as your gift. But till then, you have to report it. It doesn't mean that you don't have to report it on your gift tax return. You have to report it. But one exception is if you are front loading the amount on your qualified tuition program, it will be considered as a gift of present interest. It will be considered as you have done the complete gifting right now only. Okay. Next one is, okay, yeah, when you have to file the gift tax return, it's along with your 1040 due date, that is 15th April. Till 15th April you have to file the gift tax return. What is the tax rate? Maximum tax rate is 40% is the tax on your gifts. And when to file? If your gift is more than the annual exclusion limit of 17,000, taxpayer and spouse, if they are splitting the 1717, means 34,000 they are utilizing the limit, so both will have to separately file the 709 form. Okay. Taxpayer gives the gift which contains the future interest, still they have to report it. Please remember this. Even they are not going to pay any tax, but still they have to report it right now. If taxpayer gave a spouse an interest in property that some future event will end, right, it is also a future interest. Even it's a marital deduction, it's fall under the marital deduction, still they have to report it. Okay. Clear, guys? In gift tax topic, I hope everything is clear. You have to remember the limits, you have to remember the exclusion part. There will be simple, I remember two questions were there. One, a simple one line question was asked just for the limit of lifetime exclusion. Second, there will be a calculation sum which will be based on the estate and gift tax both. Okay, so let me explain you the estate tax topic first. Okay, just give me a minute, guys. Okay, so here this calculation will be important. We'll come to this calculation, how to calculate the estate taxes. Okay, I'll just remove all the lines. It's okay. All right, see, there is one question. Alternate valuation method. Yes, Chawla, this is regarding estate tax. So I'll explain this MCQ along with this. Okay. So see, in case of estate tax, what happens is, when a taxpayer dies, this sequence I've already explained you, right? When a taxpayer dies, Once they file the final return, after that within 9 months they have to file the estate tax. Now when filing the estate tax, what exactly you have to report it in the estate tax? So let's say whatever asset the taxpayer is having, they have to bring it to the FMV. So they are going to report all the asset at FMV on their estate return. Okay, now you have to decide this FMV can be as on the date of death or as on the date of alternate valuation date. What is alternate valuation date? It is 6 months from the date of death. It can happen, guys, that let's say a land is there, okay, a land or building is there. You cannot just straight away take a date on the date of death. You cannot straight away do the valuation. Okay, it takes time. So what IRS has given a suggestion, either you take a date of death or you can select a alternate valuation date. Okay, alternate valuation date is exactly 6 months from the date of death, right? Or if your distribution is done before the 6 month, let's say the person died in the month of January, so within 6 months means on June anyways you are going to take the FMV. Why we are calculating the FMV, guys? When you file your estate tax return after 9 months, you have to pay the taxes, which will be difference of FMV and your adjusted basis of all the asset, right? That you have to pay the tax to the IRS. So you need to accurately calculate what is the FMV. The person should not pay a huge amount of taxes. That's why whoever is the trustee or whoever is the executor, they will decide whether to take the FMV on the date of death, FMV on the alternate valuation date. Now, let's say they decided the FMV as on alternate valuation date. Now, just before this, let's say in the yeah,
If person dies on February, then when he has to file his final return, and then when he
I'll
can
come.
file.
I'll come to that point. Do not
Okay.
ask any question by unmuting yourself because this is going to be uploaded on YouTube. So please put everything in the chat box. I mentioned it at the start of the session only. I'll explain everything. When they have to file, filing thing is going to come at the end. Okay. Here it's there. When you are going to file the return. So I'll explain that. Don't worry. So make sure that if any distribution is done before this date, if the distribution is done, then the FMV will be considered on the date of distribution. They will confuse you on this point. They'll give you the distribution date just before 6 months. Okay, then make sure that if the asset is transferred before the date of a alternate valuation date, it has to be considered on the that date. Okay, FMB. So make sure when you file an estate tax return, what happens, the estate of taxpayer will pay a one time tax, which is straight away the difference between the cost and FMB, and it will be added on your 706, right? So fiduciaries can hold the property or asset for the beneficiaries, and whether income is generated before passing the property, it can happen that it's a rental real estate property. So their asset is generating the revenue for this 6 month, the asset is generating the revenue. So that revenue will also be reported on your estate return as an income. They have to file a estate income tax return. And still after 9 months, again still the real estate property is not distributed to beneficiaries, still it is generating revenue, they have to file the trust return. Okay, now coming to the point, when you have to file the estate return, you need to check. Let's say a person died in the month of Feb. Okay, as per Chawla's example, in Feb a person died. So from here, if you calculate the 9 month, right, you have to calculate the 9 month. Here you have to file the estate return. Let's say first Feb we are considering. Feb, March, April, May, June, July, August, September, October 31st till 31st October you have to file the estate return. 706 you have to file over here. Now let's take this as a 2023. When you are going to file a 1040 final return, can anyone tell me? In the chat box you can just put it down. If a person died on 1st Feb 2023, when will their 1040 final return will be filed? Final return. When will their 1040 final return be filed? No, guys, it's wrong. Krishna, it's okay. Marilyn, your answer is correct. See, what happens in 22 person was alive. Can I say till 31st December the person was alive? Right? If a person is alive till 31st December, when their final return will be filed? Can the final return be filed for 22? What is the filing deadline for 22? It is 15th April 2023, right? So here you are going to file the original return. It's not your final return. So someone mentioned 15th April 23, which is wrong. Okay. Chawla, did you get this point? In 22, the person was alive. So you have to file the original return. Now the person is dying in 2023. For 23 tax year, when the return will be filed in 2024. So he has a time limit till 15th April 24 where he has to file the 1040 final return. But before that, in October, his estate return will be filed. See, estate return, 1040 return is different. 1040, you have to report your individual income. Let's say person is earning some wage income, person is having some bonus, commission, interest, dividend. Everything will be reported on that. Itemized deduction will also be taken as it is. Just consider it as a normal return. But estate return is you're just reporting your asset to the IRS, what all assets you're having. So Prayasun, not 9 month. Okay, 9 month is just for estate. For 1040, it is the year of death you have to check. What is the year of death here? 2023. So how your answer should be 23? How you can file it in April 23? On 15th April 23, which tax year you're filing? 15th April 23, which tax you're filing, guys? Is it? Yeah, it's 22. So 2022, the person was alive. You have to file the normal return. But if a person dies in Feb 2023, you need to file this 23 return in next year's deadline, that is 15th April 24. Got it? So don't get confused on this part. They are going to ask this kind of questions. Okay. So don't get confused and select 23. That's the wrong answer. Now see, estate or trust has generated an income of 6,000. Out of that, 4,000 is given to the beneficiaries before distribution only. So either of them will pay the tax on for whatever is distributed. See, one time estate tax they have to pay. Either it is distributed or not, one time estate tax will have to pay. So 4,000 either the beneficiary will pay, or the estate tax will first include whole 6,000 as an income. They'll pay the estate tax on this, and then they'll take a 4,000 as a distribution. Okay. And when this person receives the 4,000, beneficiary will receive 4,000, they get a credit of whatever taxes is already paid by the estate. Okay. And then remaining 2,000 will be paid by the fiduciary by filing form 1041. Okay. Same way, just like we did in the gift tax topic, here also you can exclude up to 12.92 million. And each year the 70,000 is the limit in gift, that's fine. But this annual exclusion is also applicable on your estate calculation. So how the calculation will be done? Keep a recurring account. This is a kind of your bank account. Think like that. It's a recurring account, or an amount every year is given as a gift will be reduced. This balance will get reduced. So your gift amount, your estate, everything will be reduced over here. Okay. And if you have any balance left out of, this was the prior year's limit, any balance left out of 12.92 million, it will be used for the estate gift reduction. It's a kind of gift, right? Your whole asset is getting passed over to your beneficiaries. So it's a kind of a gift you are giving to them, right? The person dies and their assets are getting distributed to their beneficiaries. So one time when you are going to pay FMB minus cost, this is on this amount. If you're going to pay the tax, so this amount will get reduced, like up to 12.92. You don't have to pay any estate tax as well. Are you clear with this? Now let's say if your value is going more than 12.92, whatever is the amount into tax liability, If this tax liability is within this amount, okay, 5.11, if it is within this amount, then again you don't have to pay any tax liability. So same calculation is there in gift and estate. Now there was one question in MCQs in exam. They gave you the amount of gift. Let's say Mr. X was alive in 2022. He gifted a he gifted some property, some cash and everything, which was totaling 50,000. So can I say now his balance is how much? 1292 minus 50,000, right? So this is his balance now. Next year the person died, and his all the assets are getting transferred to the estate. So you are not going to consider 1292 as a balance, but it will be considered as a remaining amount as a balance. Clear, guys? So please understand this thing. Next is how to calculate it. FMV of the property. Always take the FMV when I talk about the estate. Minus deduction allowed means this 1292. Okay, 1292, this is straight away allowed as a deduction, or whatever is the balance in your lifetime exclusion amount. Okay, so if the gift and estate topic is asked together, make sure to reduce this balance. This is your amount which is liable for estate tax. Guys, wait, this will come over here. This is over here. Okay, amount of deduction allowed is what? This FMV, whatever is the FMV of the property, yeah, minus cost, sorry, minus cost, because FMV minus cost, on that you are going to pay the tax, right? So FMV minus cost, whatever is the amount liable for estate tax, on that you are going to reduce the lifetime exclusion amount. This is your net estate liable for tax, on which you will multiply the tax rate, estate tax rate, which is also the 34%. The gift tax rate exactly the same is there, 34%. This is your tax liability on which you will use this unutilized amount from your tax liability. Okay, it's very simple calculation. Two times you will get the benefit in estate tax. First you will reduce the balance of 1292, and then you will reduce from the tax liability balance. And if anything extra still you have a huge taxes, then you have to pay. That's why 90% of the US citizens do not pay estate tax. They are not having any gift tax, estate tax on your tax return. Okay, now it will be transferred to the surviving spouse. So please remember, let's say after utilizing this, still there is certain amount left in the lifetime exclusion, it will get transferred to the surviving spouse limit. Let's say surviving spouse has not used the limit at all, so it will be transferred to them. Okay, so I'll take one example, which Parker, Mr. Parker died. Okay, that example is there. Let's say a person died. Mr. Parker died on December 1st of this year. Let's take it 2022 for your exams. Alternate valuation method was not elected. Okay, if I say the AVD is not elected, means they are not going to use the 6-month value. The asset in the estate were valued on the date. So the person was having home with the value of 5400,000, then a car with 30,000, then a stock, bond, and savings of 350,000, jewelry of 25,000, dividend date. Okay, now see, Chawla, what's the answer for this? You didn't share the answer. The dividend date, dividend on the date of record, not paid. Okay, so dividend is record on record, means it is declared on 15th November, but not paid till 1st December. Till the person died, this dividend was not paid. Now you have to check whether this person was using cash method to file the returns or accrual method to file the returns. Okay, then accrued interest. There is an interest which is accrued on 1st December of 2500. Then we have as a life insurance proceeds receivable by estate. Okay, life insurance proceeds, it's always non-taxable. So 300,000. What is the amount of the park's gross estate? You have to find the value of gross estate. Gross estate means all the FMB you have to take and add it on. So please remember this dividend and interest. This is not the value of estate. It will be reported as a income on their 1040 final return. Okay, but let's say a person has already filed their 1040 final return, and anything which is not considered in the 1040 final return will be added on your estate return when you file it. Okay, vice versa, it can also happen that your 1040 final return is filed first and then you're filing your estate return. It can happen that, right? So in this scenario, these two situations, these two amounts should be reported on your 1040 final return. Rest all I have to first calculate it. What they are asking, what amount should gross estate? Again, read the word. What amount should be there on your gross estate? It's not asking how much is taxable, non-taxable. Okay. Chawla, meanwhile, just send me the answer for this. You have not sent the answer, so we can verify whether it's correct or not. 5400,000 plus 30,000 plus 350 plus 25 plus 300. Yeah. So what they are doing is they are going to take, yes, yes, it's 6112. So they are going to report everything in the gross estate. From that there will be a deduction. What will be the deduction, guys? What will be the exclusion? Main exclusion will be, see, this is non-taxable. This will be shown on the 1040. So first of all, for reporting as a gross amount, everything will be reported. Okay, in the, I think in the next column there will be there, foreign credits are allowed, filing a tax. Yeah, this all things you need to remember. What all things will include in your gross estate? While calculating your gross estate amount, the value of the property transferred before that. See, just before that, if you're transferring the property to your relatives or anyone, it will be added in the gross estate calculation. Certain property transferred before death where descendant hold revisionary interest. Revisionary interest means later on it was going to be transferred back to the person. Okay. Third, property transfer before death where the transfer was revocable. Again, anytime the transfer can be cancelled. Those kind of transfers done just before the date of deaths. You know what happened is, many people used to do this, like they know the person is of old age and the person is going to die, so they straight away start transferring the assets in the beneficiary's name so as to save themselves from the estate tax, because estate tax is something they have to pay one time at the time of transferring everything to their beneficiaries. Okay, transfers taking effect at the time of death, exactly on the date of death, still it will be considered in the calculation of your gross estate. Life insurance proceeds payable to the estate or if descendant own the policy, it will form a part of your gross estate. Even though you're not going to pay the taxes on it, but it will form a part of your gross estate. Okay, any gift which you are going to make within 3 years of the death regarding above mentioned property, this properties, if you have already made the transfers within 3 years from the date of death, will also be form part of your gross estate. Okay, so this point they are not going to practically test this point, but yeah, remaining all things you should remember. Value of annuities payable to the descendants estate or heirs, right? If they have annuity, the person who died is having the annuity, now it is going to be transferred to their descendant. It, the value of that annuity, whatever is the principal plus interest, the whole amount will form a part of your gross estate. Okay, then includable portion of joint estate with right of survivorship. So what happens is, let's say the person who died was also having some right in another estate. Okay, so let's say he is going to have a right on 50% of the asset of another estate, so that 50% FMV value will be added in his estate calculation. Okay. Same way, tenancies. What are tenancies? Are a lease agreements are there. Okay. If the person is a part of a joint ownership in a tenancy where he is going to earn some amount of rental income, it will also be included 50% portion of the FMB in whole estate calculation. Wherever adjusted basis is given, just ignore. Everywhere you have to take the FMB on the date of death or FMB on alternate valuation date. Okay. Property over which the descendant possessed a general power of appointment, right? Where you are having a ownership, you are having a power of attorney on any property. The person who died, I'm talking about that. Okay. In his estate, everything will be included. Qualified terminable interest property. Terminable interest property means he has transferred the property to his son, daughter, or anyone, any friend, family, and it can be terminated at the will of a transferor. It's a qualified terminable property. Anytime it can be reversed, right? Then dower or courtesy or statutory estate of a surviving spouse, right? Everything, every amount will be added in your gross estate. Community property is obviously you guys know that divided by 2 we have to take, right? All the assets, all the incomes, everything gets divided between the spouse and taxpayer. So his portion will also be included in the gross estate. So in the previous example we saw all these things are going to be added first of all in the gross estate value. After that, what all things are excluded will be considered as an exclusion, and on this net amount, whatever is the net amount, on that you have to pay the tax, estate tax. Again, before after reaching the net amount, you need to exclude the 12.92. On this you will apply the tax. From this again you will reduce the 5,113,800, the limit of exclusion of tax liability. Clear, guys? So I know most of the MCQs are wrong because you have calculated it from the exclusion point of view. They are asking just the gross estate. So if the word gross is there, straight away add up everything. Same way in the gift tax topic, you have to add up everything. Okay, clear? Now following deductions are allowed. Yeah. So this, after you add the gross estate, what all deductions will be allowed? So first you read the you understood that everything you have to add in the gross estate. From that, on what all things you are not going to make a estate tax payable, like on which amount you will get a deduction. If they are paying some funeral expenses from their estate, so you will get a deduction. You will get, like, all these incomes will be there. Income is nothing but all your assets, FME. Okay. From that you will get the deductions which are listed over here. Funeral expense, if debt is owned at the time of death, so this is mainly for medical. Okay, wait, medical expense. Do you remember the rule, anyone, that if a person is having a lot of medical expense which is unpaid till the date of death, so from the date of death within 1 year, if it is paid by the beneficiaries out of the estate, they can take it as a deduction from the estate tax return. Now you will have a question that they have to file the estate within 9 months. They have to file the return within 9 months. So ultimately, your date of death, from that within 9 months, if you're, before filing your estate tax return, if you're paying this medical expenses out of the estate, it will be allowed as a deduction. So that is your debt, kind of a debt, right? You are paying it later on, not in the year of death. Then all the admin related expense, court cost, executor fees will be allowed. Marital deduction means what? In this gross income you have also included the community property, right? Or any property which is getting transferred to your spouse, that is already included in the income. You will get straight away deduction for whatever value of property you are transferring to the surviving spouse, because on this there is no estate tax. Same way, if it is written in the will, here you have to add one line. It has to be written in the will that the person is mentioning that out of my estate I want to donate 10,000 to XYZ charitable organization. Okay, and it has to be a qualified charitable organization listed on the IRS exemption list, like, or exempt organization list. So if they are donating, this can also be excluded as a deduction from your gross estate. If any state is levying the state taxes, there is a death tax in some of the state, or at the time of death also they have to pay the tax to the state, then also it is allowed as a deduction from your gross estate. And if there is some loss due to casualty or theft in any of this property, right, any of this property, if there is a loss, take the losses amount straight away and deduct it from your gross estate. So after reducing the deductions, you will get the net estate. So make sure when you look at the question, what it is asking, is it asking for gross or is it asking for net? If it is asking for gross, it's the very simple question. Straight away add everything on the question, put it as a gross. Okay. And if it is asking for net, then you have to remember all these deductions. Without taking this deduction, that will be your gross estate value, not your do not take all this deduction and then answer the question. Okay. And if it is asking for taxable gross estate, taxable, how much is taxable after taking these deductions, this will be taxable. Clear, guys? So this was regarding, mainly they will ask based on the calculation part in estate topic, same way for the gift tax topic. Few credits are allowed on your estate tax liability. Credit for foreign that tax is paid. If a person dies in some other country and if over there they are paying something as a tax, they will straight away get as a credit when they file their estate return. Why income up to date of death is included in taxpayer final return? Okay, see, when a person dies, see, any income which a person earns need to be reported to the IRS, whether it is before death, after death. Just the reporting form is different. Before that, after that, and before filing estate return. I'll take one example. Let's say the person died in the month of Feb 2023. Okay. So just before death means, can I say January till Feb the person was alive? Let's say he died on 28th Feb. So for this 2 month, he might have earned wages income, he might have earned interest, dividend, XYZ incomes he has earned. So when you file a 1040 final return on 15th April 24, you will include this 2 month income in the 1040 return. Okay. Now they file the estate tax return after 9 months. Let's say they filed it. See, 9 months is the maximum. They can file it within 6 months, also within 5 months. Also, it depends if everything is properly sorted. Before filing the estate return means, let's say if they file the return in the month of October, 31st October 2023. So it can happen that from February till 31st October, the person is having a real estate property on which they have earned a rental income, right? This rental income will be reported on their estate, because this is after the date of death. Whatever person is earning will be reported on their estate in the gross estate. Right now we saw the calculation, gross estate, add it in that. Okay. Clear? Now, after filing the estate return, let's say from 1st November till 31st December, still the person is again earning a rental income. Okay. This, if the beneficiaries are directly taking this rental income in their bank account, then it will be shown on their 1040 return as a taxable. Okay. If it is they are not taking, still it has been taken in the name of estate, then they will have to file a 1040 return as of 15th April 2020 24. next year. Okay, so this is 23. Are you clear with this, guys? Each and every income which has been earned, they have to report it. It can be either on their 1040 final return, or on the estate, or on the 1041. It depends on the timing of when you're earning it. Okay, so make sure that you remember this. Next is what all deductions you get. One is for if you paid some foreign taxes, you get the deduction. Credit for federal gift tax. Okay, federal gift tax means on, like, it was before 1977. Now you don't get this kind of deductions anymore. Taxes on prior transfer. Previously, if you have transferred and on that you have already paid the estate taxes, okay, then you get the credit for that estate tax paid from your estate tax liability. Okay, now there is one more rule. 10 year before the date of gift, okay, person who gifted died 10 year before the date of gift. Just a minute, I think some columns are being missed over here. Person who gifted died, then descendant received the gift, and estate tax paid will get a credit. Descendant received the gift, person who gifted died, okay, 2 year after the date of it. Okay, so see, a descendant who received the gift, the person who received the gift, before receiving the gift, before receiving, the person who gifted him the gift died 10 year before the date of gift, or just after giving the gift within 2 years the person died. So here, whatever estate tax was paid at this time, or whatever estate tax is gonna pay after 2 years, this person will get the credit of it. Okay, are you guys clear with this? They'll not ask any question based on this, but just remember the 10 year and 2 year criteria. Let's say you receive a property right now, and the property which you receive is due to the person who died 10 year ago. Okay, it should be directly coming from that person. It can happen, guys. See, when you file a estate return, as soon as you file the estate return, your allocation is not going to be completed on the same day. Allocation of property will take time. It take 5 years, 6 years, 10 years also. So maximum they have given a limit of 10 years. So after filing the estate return, like from the date of death, within next 10 years, whatever property has been allocated, whoever receives the property, he will get a credit of estate taxes paid, because no one can take a credit of estate taxes paid unless they receives the property. So next 10 years they were filing a 1041 return. Whatever the rental property was generating income, it was reported on 1041 return. But they were no one got the property as a distribution. Right? So in that scenario, they gave a time limit of within 10 years if you're transferring, the person who gifted has died within 10 years limit, then whoever is receiving will get a credit on estate tax paid. Also, let's say I received a gift, and at that time you have paid a gift tax, for example, right? It was a huge amount, so someone paid a gift tax on that property, and that person died after 2 years. So whatever gift tax he or she paid, I'll get the credit for it. Okay, it will be considered as a when you receive, like, you need to just report it correctly on your return while filing the original return. And after 2 years, see, you can easily amend your return. Prior 3 years return you can easily amend, so you can go back and amend and take a credit for whatever gift taxes were paid by the donor. Else you don't get any credit for gift tax paid by the donor. Okay, but if this is the scenario, this is an exception. Now, filing an estate tax return is not necessary if your gross estate plus adjusted taxable gifts are up to 12.92. So here you don't have to file any return if it is within this limit. How many months you have to file it? From the 9 months from the date of death. And if you need an extension, you can still extend it by 6 months by filing in 4768 form. Okay. if the estate is having an income of more than $600. Remember the example, if the person is having a real estate property and they are generating the rental income. So if the estate income is more than $600, then or the beneficiary is a non-resident alien, then they have to file a 1041, which is due on 15th April. Okay, and if they are using any other fiscal year, then it's simply 4 months from the end of the year. Just a minute, guys. Okay, so next is, okay, where we were. Yes. So extension is like, yeah, if you're going to use any other year, then again 4 months you have to calculate from the end of the year. And personal representative can request an automatic extension of 5.5 months. Okay, instead of 6 months, you can just ask for 5.5 months if you're using any other fiscal year. Else, normal tax year, if you're using calendar year, you have an automatic extension of 6 months. Okay, gross estate definition we already saw. This all things will be included. Apart from this, any income which a person is earning which is not included on the 1040 final return will form a part of your gross estate. Please remember this thing, do not make mistake. It has to be reported somewhere on your any of the three returns. It can be on 1040 final, it can be on the estate return, or it can be on the 1041 return. You should not miss any income reporting. Okay, now the last one in this topic, specialized return, is not the last. Foreign taxation is also there. So see, final return, descendants final return will be filed at what time? The deadline is 15th April, but here it will be 2024. If a person, write this example, guys, so you don't forget it during your exam. When a person died any time during 2023, then for them the deadline will be 15th April. Now let me ask you one question. When a person died anytime during 2024 tax year, what will be the deadline for them? What will be the final tax return will be filed on which date? Yes, correct. Final tax return will be filed on 15th April 25. Okay, now person who is responsible to file, their surviving spouse, relative, executors, they are responsible to file the tax return. So if a taxpayer died between January 23rd to 15th April, then it, in that case 22 tax year will not be the final return. I have mentioned here clearly. So please remember, it's not their final return in that year, it will be in 2023, the year in which they are dying, that is the final return. Okay, if a surviving spouse doesn't remarry, then they have to file it as a joint return with the descendant. This thing you remember in our filing status chapter, right? Surviving spouse if remarries, then they have to file a MFJ with the new spouse, plus they have to file a MFS with the descendant spouse and tick the checkbox as a final return. Now, court appointed representative is there, then representative can revoke. See, if representative feels that the surviving spouse and taxpayer should not file a joint return, then they are going to revoke this selection. Okay, next is income to be included in the final return. Income in respect of descendant, all income that descendant would have received if the death was not there. So this, I think I have already explained you, till the date of death everything will be included in the 1040 final return. From the date of death till the estate is filed, everything will be included in the estate. Once the estate is filed, after that, whatever they earn will be included in their trust return. Okay, but here what thing you need to remember, in exam they can confuse you with the word cash method and accrual method. So they have the option, whoever is filing the final return, they have the option to file the return as per the cash method or accrual method. And mainly the question will be asked on dividend accrued and interest accrued thing. Okay, so let me explain you this. If interest is constructively received before death, I hope you remember the word constructively received, means it is received in your bank, okay, or you have received the check but you have not yet deposited, means you have the authority to utilize that amount. So that is constructively received but not cashed. It will form a part of your gross income on your 1040 return. It will form a part of your interest schedule B when you're using a cash method. When you're using a when you receive a dividend, if it is received before death. Now let me tell you one example. Chawla has shared one example. In that there was one scenario. Yeah, let's say dividend date of record date means what? They have declared the dividend on November 15, but it is not yet deposited in bank till what date? Till 1st December, and the person died on 1st December. Can I say it is just a declared dividend, not received? Then if you're using a cash method, no need to include this in your 1040 final return, but it will form a part of your gross estate. When you calculate the gross estate thing, then it will form part in your estate return. Okay. But what will happen is, in case of accrual method, since it is accrued on the date of declaration, it this dividend needs to be added in your 1040 final return. Please remember this rule. There will be one MCQ on dividend topic. I'm talking about 1040 final return, not estate. Okay, clear? Just write it down here, like most IMP dividend something, like, so you can remember this, example. Okay, so here it is written. See, declared date, receipt date. The date of death is falling between these two dates. Then do not include this dividend in the final return if you are using a cash method. Okay. In accrual method, all income when earned, any income accrued before that will be included in the final return. Whether it's interest, dividend, accrued income will all be included in your if you're using accrual method of reporting your taxes. Okay. Now, income in respect of descendant, capital asset, other asset, receives a step up basis. If you have a capital asset, it receives a step up basis, means we have done in the estate topic. Estate return we saw FMV minus your cost, right? So you are increasing the basis. So when the person who receives the asset, let's say the distribution has been done to the beneficiaries, when they record that asset in their books, it will be recorded at FMV, not as at an adjusted basis, because already the estate has paid the taxes between the basis and FMV. Okay, so the capital asset which is getting transferred to them, they receive a step up basis and transfer to the beneficiaries due to death. Capital assets and any transfer to the beneficiaries due to death. Second is any other asset. Let's say it's a interest income, dividend income, any income. No adjustment will be there on the basis. So descendants estate, if estate receives it, it will be considered as a income. In which return? With this we have already done twice or thrice now. Okay. In estate, if the estate is receiving the income, okay, directly if the beneficiary is receiving the income, they it will be included in the beneficiary's income tax return. And any person other than beneficiary, any person who directly receives it, it will be added in their 1040 return. Clear, guys? Okay. Now this is that medical expense deduction which I was explaining earlier. Whenever you receive a medical expense deduction, if it is paid before the date of death, right, so treat it as an item as deduction, just a normal schedule A, it will be added, all expense will be added on the schedule A item as deduction. If it is not yet paid after the date of death, if it is not paid, then you need to consider it on, if it is paid within 1 year, as I mentioned, within 1 year, if it is paid by the estate from the date of death, then treat this medical expense on their descendants final return and itemize it. Means you can still include it on a schedule A if it is paid within 1 year from the date of death. Okay, do not include it on the estate. If estate is paying it after 1 year, then it is allowed on the estate return as a deduction for medical expenses. Okay, clear, guys? Okay, this there will be a question on this part. Please remember this particular thing. Next is loss deduction. Any net operating losses which are being carried forward from the prior years. Let's say you have a capital loss, you have a any losses which are from the prior years will be allowed, but only on your 1040 to settled off. Let's say you have a capital loss on 1040 final return, you have a capital gain. So maximum it will be settled off against this. Rest will lapse. It cannot get carried forward to the estate return. There was one question on this thing also. Your capital losses, net operating losses from the prior year, capital loss carryover can be deductible on descendants' final return. That's it. It cannot get carried to the estate return. Same way, credits are applicable to the descendants are only allowed on the final tax return. So when you file a final tax return, the person might be eligible for child tax credit, for education, AOTC, for some refundable, non-refundable. All credits will be allowed on the final return. Think as if you're filing a normal 1040 return. Only one difference is you will just tick a one check mark box. This box is filing a final return. That's it. Rest whole return is same which you file for a normal 1040 person. Okay. Sorry. So next is terrorist or a military action. If a person dies because of some terrorist or military related activities, then all your income, all your distributions will be non-taxable. Non-taxable to descendant. Estate distributions are also non-taxable. It only and only applies to the member of U.S. Armed Force. If the person dies because of wound or injury, which is incurred during their activity, during their job, and year of death, it is non-taxable. Year of wound also it is non-taxable. Let's say a person got injured in 2022. Okay, and he's transferring the estate and some money or everything to their beneficiaries, it is non-taxable. After that, in 2023, the person dies because of this injury, right? So year of death also it is non-taxable, year of injury also it is non-taxable, and 1 year before the injury it is non-taxable. Prior to injury, 1 year, whatever transfers you have made. So total 3 years. Let's say person got injured in 22, from 21, and let's say the person died in the next year, so this 3 years it will be non-taxable. Okay, any transfer which you make to your family members, estate tax will not be considered on this, or any transfer related taxes, gift tax or anything will not be considered on this. Okay. Okay, guys. So next one is foreign taxpayer and accounts. Will quickly complete this one topic and then we'll take a 5 minutes break. I think I have to complete it till 10:30 only. Right now it's 10 a.m. So yeah, I have one appointment at 11. So I'll try to complete it till 10:30, this one chapter. And then tomorrow, full day, I will be taking the session. You just have to wake up a little bit early. I'll give the timings and all. And even if you're not available, that's okay. This all recordings are going to be uploaded on the YouTube. That's fine. And few chapters are already there. I'm not sure you have visited the YouTube channel or not. The first few chapters are already there. From only the pending topics which are remaining, the property thing is there, and a few chapters are remaining that I'm going to cover in this. The whole playlist is ready for you guys. Okay, I'll share the whole playlist link in the group, so you can just start revising the topic one by one, and make sure to ask me the questions on those topics the way you did in the estate and gift tax. Same way for other topics, be ready with your doubts. Send me the pictures of MCQs which you have faced problem. Okay. See, foreign taxpayer and accounts. If a person is a US citizen, but the person is also earning a worldwide income, so the person has to fulfill two tests. One is green card test, second is substantial presence test. If the person fulfills these two tests, all their worldwide income will be taxable as per the slab rate, right? You don't have to remember the rates. Maximum is 37. You have to file a 1040 for that person. A person does not fulfill any of this test, but still he is generating the income from US. Okay, so or if a person is married, so taxpayer is married at the end of the year to a resident, the taxpayer can choose to file a resident or non-resident alien. So taxpayer will only be taxed for the only US source income will be taxable. But if you are a resident, if you fulfill this two test, worldwide income will be taxable on your 1040. Here you need to file a 1040 NR. Now what is non-resident alien? If a non-resident alien is not fulfilling this two test, can anyone tell me what was the test for substantial presence test? Green card is simple. If you are having a green card, like if you are a lawfully resident in US, so you fulfill the green card test. What was the? Yes, 31 days in current year, and there were two more years which you need to check. 183 days in total, but you have to do the 1/3, 1/6, if you guys remember. Okay, let's do that first. See, substantial presence test means 31 days present in US during 23. For your exam, 23 will be there. Then 183 days, this is the first condition. Plus, along with this, you have to fulfill the 183 days condition in last 3 years. What are those 3 years? Just a minute, guys. Okay, so now here 183 days you have to check for 3 years. There will be a simple calculation sum in the exam. They'll give you the number of days. So for 23 current year, count all 100% of the present days. For 22 you have to count 1/3, and 21 count 1/6. This all should go, either is it equal to, even if it's equal to, then also it will work. Okay, equal to or more than that, then 183 and plus current year 31 days. Okay, next is, okay, coming back to this point, non-resident alien. If you are a non-resident, you're filing a 1040. Any independent personal services which you provide, means if you are performing in foreign or direct payment you are receiving, that's your foreign source income. See, for me, let's take my example. I am a non-resident alien in US for now. Okay, let's say I have not fulfilled that 31 days and all those criteria I have not yet fulfilled. So I am a non-resident alien. So for me, what happens if I'm going to file the 1040 NR and I am providing independent personal service? The service which I'm providing to you guys is an independent personal service where my personal involvement, it's a kind of an active services. Personal services are been defined as, if let's say instead of me taking the lectures, if some other faculty takes the lecture, you have not purchased the lecture for that faculty, you purchased the lectures for me, right? So I am providing you the personal services for me. Whatever income I'm earning from you guys will be a foreign source income performed in the foreign or direct payment. Foreign payment either I'm receiving or direct payment I'm receiving. Okay, then I have to report it on my 1040 NR. Second is effectively connected income, means activity active income for business connected with US. Here you need to check your number of employees. Let's say if you set up a business where your major employees are located, from where you are majorly earning your gross income, the gross income test and employee test, and where your major assets are located. So here you will see the two tests, asset test and business activity test. Based on that, you need to check for this non-resident which country he is having the effectively connected income, whether it's US or whether it's India, for example. Same way, fixed determinable annual or periodic income. These are the two tests which you can use to identify which country you are going to report your income. So here we have two tests: passive income, where you will check all your passive incomes. This will straight away be taxed at 30%, or tax treaty will give a lower tax rate. Okay, let's say I am a non-resident alien. Oh, just a minute. Yeah, even I'm a non-resident alien. To get a new pencil, wait. Even if it's a non-resident alien, and if a person is having some dividend interest income from India, for example, person is located in US, he is not yet resident, but he is generating some passive incomes from India, then on that income straight away 30% will be taxable. Okay, but on the other hand, when I'm going to file the return in India, I'll get a credit of it. Don't worry, it's not a double taxation. So please understand this thing. If you're filing a return, a 1040 NR in US, being a non-resident alien, on these three things you have to pay the tax. You have to report it in your US tax return. On other hand, you will get a credit when you file an Indian tax. Okay, clear with this? But you have to understand the definition of this thing. Apart from this, nothing will come into picture. Just understand, if it's a direct personal services, it has to be considered as a foreign source income on your 1040 NR. If you are earning some passive incomes, okay, so straight away 30% over here. And if you have a effectively connected business over here, so what it is: business activity test you have to fulfill, asset use test you have to fulfill. Business activity test means if you're generating income, if you have gain or losses from activity in US trade or business. If you're straight away generating income from your from business activity in US, then your effectively connected income is in US. You need to check how many assets you are having. Let's say you are running a business where your main assets are located back in India only. From there, you are providing the services. So your the asset, main location of asset is in India. So your income from US asset used in conduct of US trade or business will be India, not in US. Okay, if any income you're generating from the assets in US, if it's situated in US, then it is called as effectively connected income in US. Clear, guys? So they'll not ask any direct or indirect question on this topic. But yeah, the green card test, this receipt test, you need to remember. Substantial presence test, sorry, you have to remember these two things. Okay, after that, whatever withholding for non-resident, whatever withholding are been done, US person who pays an amount to non-resident, if a person, US person, let's say if someone is paying me the wages amount, let's say, okay, and I am going to receive, instead of receiving $100, I received only $70. So that $30 which this person withheld and paid to US government, they will have to report it on form 1441, 42, and 1442. 42 and 42 is twice. 41 and 42 is only there. Okay. So US person who pays an amount to non-resident for withholding, also known as withholding agent, they are withholding this $30. They will have to file this withholding form with the IRS while paying the amount to the government. Okay, clear, guys? Now, illegal aliens are not allowed. Obviously, they are not allowed to earn anything. But if in case it is caught that in US they are earning something, so US employer or payer who hire the illegal aliens may be subject to various fines, penalties, sanction, and all the legalities they have to face. Now, one thing you need to remember: if they are generating any income and it is caught, they are straight away liable to pay 30% of withholding, unless there is some exemptions for that. Okay. Now, resident. plus who receives income from performing personal services are subject to same reporting and withholding obligation that applies to US citizen. If a person becomes resident because of the physical presence test, 31 days and those 3 years, those tests, if they fulfill, then they will be considered as a resident. And any personal services if you provide, okay, you will have to report it on your 1040 return. Okay, now being a non-resident, let's say, who is not fulfilling those tests, my example, okay, I'm not fulfilling those all tests, I'm not there since last 3 years, but if I am generating revenue from here, right, I have to report it on the 1040 NR. For that I have to use my ITIN or maybe SSN if it is generated. Okay, clear? And receives the income for employers and payers. If anyone who receives income from employer and payer, same tax withholding and reporting obligation will apply as it applies to other, even if a person is illegal alien, and if they are falling under any of this category, all the normal tax treatment will be considered, along with they will have to pay the fines, penalties, along with they have to also withhold the extra 30,000 of all the incomes which is paid to the illegal aliens. Okay, now 1040 NR, this is important. They might ask something from this. 1040 NR is mandatory for whom? Any non-resident who is engaged in trade or business, who is conducting any business in US, who is having a gross income, okay, from the US source, except losses from the asset transaction. All the incomes will be added, all the incomes will be reported, but they are not allowed to claim any loss from sales of asset. Non-resident who is not engaged in US trade but received income from US source. Okay, let's say they receive some interest income, some dividend income, then they have to pay. They have to file the 1040 NR. Received a health saving or medical saving or Medicare Advantage from anywhere. Okay, it can happen they are working with some employer and they have taken their health saving account. They have opened the health saving account for that person. Then you have to report it on 1040 NR. If you are having a self-employed income of more than $400, or you receive a advance payment of premium tax credit marketplace. Okay, I hope you remember the premium tax credit rule. So if you are receiving the premium tax credit, if you want to claim it on your return, you have to obviously file the return. Represents individual or trust who are required to file a 1040 NR. Okay, any representative of an individual or trust, let's say I am in India for example, and still I'm earning some income from US, and due to my income is on a very higher level, I have to file the return. So since I don't have any ITIN or something, I'll appoint a representative who will file the return on my behalf, so they will have to file the return. That will be 1040 NR. Okay, taxpayer held a qualified investment in the qualified opportunity fund. Okay, I'm not generating any income, but just I've held the investment, so it has to be reported on 1040 NR. If you are fulfilling the dual residency status, you are resident in US also, you're resident in India also, you will be treated as a NR in US. Like you have to select, you have to check the tax treaty and all those things. What are the rules? Okay, if you own a special tax, that is AMT, or any additional taxes on qualified plan, let's say you are already have invested in the IRA, or you have to pay a household employment tax. What is household employment tax, guys? Anyone is aware about it? Household employment tax, anyone, guys? See, if you hire someone to work for your home related activities, if you hire some gardener or some nanny or some um what we say, cleaner or some, like what, I don't get, I don't remember the exact word, but those who are specifically going to work for you, okay, let's say you hire a gardener, you're paying them a certain amount. If it is above a specific value, you have to deduct the taxes while paying it to them. Those are exactly the same percentage, social security and Medicare taxes. Okay, so that is called, the word they use is household employment tax. Okay, you are working from the home, like you are hiring someone as to take care of your home, and then you are paying the salary or wages, on that you are deducting the taxes. So if you're going to own a special taxes, then you have to file a return. So social security, medicare tax on tip income not reported to employer, or any recapture taxes. I hope you know what is recapture taxes. Previously, any deductions which you have already taken, let's say if it's a property related amount like depreciation, you have already taken as a deduction. Now if you're selling that property, those depreciation gets reversed, recaptured. Okay, so 1040 NR is mandatory for this all people. Please remember the list of this. Then there is an exemption. We know that there is a standard deduction for individual person, right, for MFJ, MFS, and all those filers. Same way, when you are a non-resident alien, you are exempt from filing if a person is just a student or a teacher or a trainer and there is no income in their in their tax return. There is no income they are generating. Or even if you're a student or a business apprentice, means you're there on the training basis, right, and if your gross income is less than 13,850, or if a person is a surviving spouse, that gross income is up to 27,700, then no need to file the 1040 NR. Okay, and if a person is a partner of a US partnership not engaged in the trade or business, you are just a partner in the US partnership, but that is not generating any income, then also you don't have to file any 1040 NR. Okay, so these are the three conditions you can remember, and for whom it is mandatory to file, for whom it is not required to file. Now, what are the filing status which non-residents can use? Single, MFS, MFJ, and HOH are not allowed. Please remember this thing. Or a qualifying surviving spouse only if they meet the criteria as a qualifying widower for 1040. Then they can file as a qualifying widower 1040 NR. Okay, if you are married, let's say taxpayer is married, spouse is a non-resident, taxpayer is a resident. If married, still they have to use a MFS status. Please remember. Now there will be one more option. They can file as a MFJ, but the spouse will have to declare all worldwide income as a taxable in US, and they will not receive any benefits of credits, any adjustments, any deductions. Everywhere there is a restrictions. So ideally, normal layman person will not go for this option, that declare as a MFJ and file the whole return. Worldwide income will convert it into US dollars and you have to pay the tax in US. The income which the spouse has earned in India, she has to pay the taxes in US, which is of not at all any benefit. Okay, and no exemption will be allowed for dependents. So even if they file as an MFJ, if they think that they can claim as a they can claim the credit for the child, for the dependent, they cannot claim any exemption for it. Okay, now what are the deductions? What are actual deductions which they are allowed? Standard deductions are not allowed because they are given a flat deductions of 13,850, 27,700. They cannot go for a standard deduction. Itemized deductions are allowed on Schedule A, but only and only for state and local income tax, charitable contribution to US organization, not to anyone other in other country. And if they incur any casualty losses, then that will be allowed. They are not allowed to take the medical expense. Okay, so there are so many restrictions. If you are filing as a NR, you have to remember this exceptions. These things are not allowed. Mortgage interest, they cannot take it as a deduction. Okay, so please remember, only and only any state and local taxes, any charitable contributions you are making to the US organization, only this are allowed. So what are the due dates? What are the due dates? If you are filing as an individual, all the wage income plus withholding, if it is done, you need to file it till 15th April, and you can automatically extend it by 6 months. The same thing is there, just the difference is if you do not have any wages or withholding, instead of 15th April, the due date is 15th June. That's why many people right now, those who are working in practical life, they are aware about this date, that for non-resident filers it is 15 June. If they don't have any wages but they just have some investment income, they have some interest, dividend, all those incomes, then they have to file it till 15th June, and again they get a 6-month extension if they want to go for it. Okay. Then there is an estate and trust. Office or organization is in US. Okay, some estate and trust are there. If they have an office and organization in US, they have to file the estate return, trust return by 15th April. It can happen. There is a practical scenario. I'll share it with you. The person, the the child were living in India. Their parents were living in US. So the parents died at the time of COVID. Now what happened? This people will have to file an estate return over here because they are the only beneficiaries. For them it will be a estate return where organization, or like let's say the whole main assets are in US, so they will have to file it by 15th April. Okay. Now let's say if it's a trust return, it's just a trust return. The parents have created a trust for this Indian children's, right? And it is in India itself, but since it has been created by the US people, there is no office or no organization in US, but still they have to report it by 15th June, their estate or trust related all their incomes. Okay. Clear, guys? So I know for foreign transaction things it's a bit complicated. In exam they are not going to ask in so much detail. Okay. After your exams you can do a little bit more research on how Indian taxes and US taxes are going to be considered. Okay. Just a minute, guys. Okay. Next one is foreign account and asset reporting. So in this topic, you have to remember the form numbers. I have seen in exam, they have asked the form numbers, they have asked the limits, they have asked the penalty thing. Not penalty, but some numerical limits were asked. So here, what is the FATCA requirement? You have to report your foreign financial asset. Okay. Report on 8938 form by the due date of tax return if you have a foreign asset. If you have invested in foreign asset, which as on 31st December, you have to check. What is foreign financial asset, guys? If you are having a bank account in other country, being a US citizen, if you are having a bank account in other country, then you have to report it to IRS on form 8938 by 31st December, or at any time during the, see, even as on 31st December the balance is not 50,000, then you have to check during the whole year. At any point, as soon as your balance exceeds 75, you have to report it on 8938 form. Okay. Else what will happen? If you do not report it, you will have to pay the penalty of $10,000 for failure to disclose, plus every 30 days it will add on 10,000, and maximum 50,000 is the penalty. Potential maximum penalty is 60,000 if you are doing some fraud. Intentionally you are not reporting, or because your assets are very higher, you are doing some fraud and transferring asset here and there to save yourself from reporting. They might charge a maximum penalty of 60,000, plus any criminal penalties can also be levied on that. You don't have to remember any criminal penalties, but just remember the FATCA requirement where you have to report your foreign financial asset to the IRS. Okay. Next is F bar. F bar is like just like your foreign financial asset. You have to report all your foreign banks and financial accounts. Just a bank account you have to report. Here you have to report everything. Your foreign bank, if you have some investments, deposits, uh, any foreign asset you are going to have which is going to generate it's just like your investments. Let's say fixed deposit is there, your shares and securities, those are financial assets. Okay, some deposits, FDs are there. Here it's just your bank account. You're maintaining a bank account, then you have to report it on your FinCEN form 114. Okay, so financial interest in or a signature authority if you have in the foreign financial account which is having the value of 10,000 at any time during the year. Due date is till 15th April. You have to report it on form 114. And the penalties is like higher of 100,000 or 50% of your balance plus criminal penalties. If it's not a willful, this is due to fraudulent or something. And if it's not willful, it's straight away 10,000. Okay, clear, guys? So specialized return is done. I would request everyone to revise it again today. Tomorrow we are going to have the sessions since morning, full day. Okay, there is one question. In FATCA, bank account plus any asset or property, and 114 is, yes, correct. FATCA is for including your bank, including your financial assets, everything needs to be reported. Okay, only financial asset, huh, Krishna? It's not everything. Financial asset. And 114, it's just your foreign bank accounts, you have to report it. So when you file your tax return, in that only there is one form, 114 F bar reporting. You have to just mention, convert the balance of your bank account into dollars and then mention it on the that your form. Just a minute, huh, guys. Sorry, guys. Yeah, timing I'll share, Chawla. In few hours I'll just share the timings. Financial asset, I said, like it's a fixed deposit. Fixed deposit is your what asset? It's a financial asset. Okay. Yes, Robin, you have any question? You can just put it on the chat box.
Yes. If you please can share the link for the videos, that will be great.
Yeah, that I'll share in the group.
Yes, please. Thank you.